Hey, it's Jim, and this is FRM Part 1, topic on foundations of risk management, and the chapter on modern portfolio theory, and the capital asset pricing model, which has to be one of my favorite topics because it establishes the foundation of modern portfolio theory, which means that we have to talk about history. We're going to have good discussions on the founding fathers of modern portfolio theory, and we have to go all the way back to the 1950s. Even I wasn't born back in the 1950s. So let's take a look at some of these learning objectives. There we go, modern portfolio theory. Harry Markowitz, there you go, 1952 and the efficient frontier. There's the capital asset pricing model, William Sharpe, 1964. And then the extension, actually, it's kind of a link between Harry Markowitz and the capital asset pricing model. We'll spend some good time talking about the capital market line. Of course, we'll have to talk about standard deviation as a measure of total risk, and we'll have to talk about beta as a measure of systematic risk. And then take a look at that last learning objective down there. I can't imagine that GARP would put together an exam without asking you to either calculate or interpret Sharpe, Treynor, Jensen information, and Sortino ratios. So there's lots and lots of good equations that you're going to have to memorize. So let's get started on memorizing these things. We begin by going back to 1952 and a 25-year-old graduate student named Harry Markowitz, who, and remember, there was no such thing as the discipline of finance in 1952. So Harry Markowitz was working on his PhD in economics and came up with this thing. And his economics professors all said, this is not economics. We don't know what it is. And so he was clearly the initial founding father of modern portfolio theory. And his idea was to take management science, take a combination of expected returns and risk, and he called that standard deviation, and put that in a graph. Of course, he won the Nobel Prize in economics for his work, but essentially what Harry Markowitz has done is formalized the idea that all investors, they want lots and lots of expected return, and they want just a little bit of risk. But of course, those are mutually exclusive. You can't have lots of return and little risk. So Harry Markowitz, being a good economist, decided to look at these things like marginal costs and marginal benefits and said, all right, this is what we want to do. We want to do both. We want to minimize the possibility of risk out there and then find the maximum expected return at that level of risk, at that minimum level of risk. And then each level of risk, as we move along the axis, you'll see that in a graph here in just a minute. Of course, Harry Markowitz's work led to the concept of diversification, which we know reduces total risk. And the reason that it reduces total risk is because we can't look at individual securities in terms of just their individual risks. We need to examine how those risks relate to each other, and we call that the correlation. How about correlation? Isn't this fun already? So Harry Markowitz and other founding fathers of finance, they decided that in order for them to begin this discipline of finance, we needed to reduce the complexities on the floor of the New York Stock Exchange to just a simple model. So look at some of these assumptions. And by the way, each one of these are good assumptions to ask on the exam. So you'll have to memorize these things and be able to interpret them and identify what the implications of these assumptions are. So no taxes or transaction costs. So think about this. That means that there's essentially no government out there, and there are no middle individuals who are charging fees for buying and selling securities. Look at that second one. Boy, this is the analogy that I give my students all the time. I go back to one of my favorite movies, 1984, 3, the Terminator, where Arnold Schwarzenegger plays the Terminator. He's a machine. And those of you who've seen this movie, he's walking down the road and he's like a computer. So he's processing and processing and processing. So all investors, they can identify all the relevant information to price a security. They don't have to pay for it. They have instant access to it. It's like the Terminator. Now, based on that assumption, then we have some other assumptions here. That next one here, that no single investor can influence prices, which means that nobody can show up on the floor of the New York Stock Exchange. Imagine someone showing up with $1 trillion and gets in the buy line to purchase shares of Johnson & Johnson stock. Well, if the investors and the market makers and whoever else is on the floor of the New York Stock Exchange, if they see you with $1 trillion ready to buy shares of Johnson & Johnson, well, that's going to impact the price. So that scenario doesn't exist. And here's the next one that lots and lots of people either really like or they really question. So returns are normally distributed. And what we know, and we'll see this throughout part 1 and part 2, is that stock returns are nearly normally distributed. That's not a correct or acceptable technical statistical term, but a lot of times they are normally distributed. Sometimes they're not, and sometimes they're not anywhere near normally distributed, but the assumption here lies. Investors are rational, which means when they make these decisions based on normal distribution of returns, that investors only need the first 2 moments of the distribution. They need the mean and they need the standard deviation. So that's why that sentence reads, based solely on expected return, there's the first moment, and risk, standard deviation, that's the second moment. We assume that investors are risk averse, meaning that in order to motivate an investor to take on extra risk, right? Marginal, the extra dollar of risk or the extra increment of risk, that you've got to offer that investor some compensation in the form of a higher expected return. And then, of course, when you combine assets that do not have perfect 1.0 correlation coefficients, then what happens is that you reduce total risk. And we'll see some good graphs here in this slide deck and multiple slide decks in the future about the relationship between diversification and systematic and unsystematic and total risk. So Harry Markowitz, he developed this model. And by the way, you can easily whip out your Excel solver program and compute and draw the Harry Markowitz efficient frontier. So this is really just a set of risky assets. So imagine going out to the New York Stock Exchange and collecting 10 monthly stock prices for 10 different stocks. Throw them into an Excel spreadsheet. Use Solver to minimize the standard deviation while finding the maximum return at each level of that standard deviation. And that's the picture of the efficient frontier. What Harry Markowitz did was he decided to call this set of points the optimal investment portfolios. He called them efficient portfolios. Any portfolio that falls on the efficient frontier is known as efficient. Portfolios that fall below that are known as inefficient portfolios, because you can always find a portfolio that has either more expected return or less risk. You'll see that here in just a second. Portfolios that fall above the efficient frontier are known as unattainable. You just can't get them. This goes back to what I was saying a moment ago, that you can't have lots and lots of expected return with little risk. These are unattainable. And so note that, what is that, the fourth teardrop point down there, there's the term trade-off. And that's what we're doing. We're trading off risk and return and trying to find these optimal portfolios, these portfolios that are efficient. Now, Harry Markowitz identified what he called the minimum variance portfolio. So let me just remind you that standard deviation is the square root of the variance. So Harry Markowitz could have called this the minimum standard deviation portfolio, but it was too many words. And so he used the correct economics and statistical term there, the minimum variance portfolio, which is just standard deviation squared. And what this means is that if we have just 10 stocks, like I was suggesting a minute ago, that this minimum variance portfolio is how do we arrange those 10 stocks to get the lowest possible standard deviation, the lowest possible variance. And then Harry Markowitz identified this maximum return portfolio, which identified the relationship between an individual investor's acceptance of risk. In other words, each of us has their own indifference curves. Some of us have steep indifference curves. Some of us have flat indifference curves. So depending on our preferences for risk, what is our acceptable level of risk, we're going to find that portfolio, and we call that the maximum return portfolio. So these are all super clear, important concepts that could show up on the exam, at least in terms of definitions, if not their applications. All right, there's this graph, and we'll see this multiple times throughout this slide deck. Notice on the vertical axis, we have expected return. On the horizontal axis, we have standard deviation of return. And so we have a couple of portfolios here. So look at K. Let's do that first. K is an inefficient portfolio because it lies below the red line, the red curve, right? It's a locus of points that has portfolio P and M on those things. So what we're saying is that when you fall directly on that line, P and M, those are efficient portfolios. K, on the other hand, is an inefficient portfolio. And L, of course, way down at the bottom, that's, I don't know, Harry Markowitz didn't call it super inefficient, but I'm going to call it that. And if there were a portfolio up there, let's say Q, way up at the top left in the northwest corner, that would be an unattainable portfolio. So here's the analogy that I give my students. What Harry Markowitz did is he pretended that he was a football coach and that he took his 5 offensive linemen and he started them all the way out to the high point of the horizontal axis. What's the goal of the 5 offensive linemen? You know, these are big, strong men. What's their goal? You remember that cheer in the old days, push them back, way back. So what Harry Markowitz said is these 5 offensive linemen are going to start way out here on the right, and they're going to push the defense back. They're going to push and push and push, right? First down and second down. They're pushing and pushing until they can't push any longer. Now, you might think that they're going to stop at the expected return, but they're not. They're going to stop at the goal line when they score a touchdown. And that goal line is the minimum variance portfolio. In other words, the offensive linemen can't push any further. In other words, with these collection of stocks, you can't get any lower possible standard deviation. That's the minimum variance portfolio. And then what the offensive linemen do is then they kind of turn, and I'm making this up in the football rule, they turn and they start pushing northward, right? That expected return. And that is what happens to form the Harry Markowitz efficient frontier. Every one of those points is the highest expected return at that particular standard deviation. So there's K, that's suboptimal. We call that inefficient. There's L. We don't even have a name for L. That's super inefficient. All right. So what Harry Markowitz did in 1952, and this occurred for the next 10 years or so. So people were thinking about this equation. I'll show you this equation here in just a second. We're thinking about this efficient portfolio and how it relates to what do financial institutions do about risk? what do individual and institutional investors do about risk? And so everyone was thinking about this and contemplating. Remember, Harry Markowitz, 25-year-old graduate student at this time. I mean, gosh, when I was 25, I was lucky. I was lucky to get out of bed. But here we go, Nobel Prize winning work. And so what investors then said is, all right, this is awesome because now we can identify the level of risk using standard deviation. And that was an incredible leap in our understanding of the risk-return trade-off. Now remember, in 1952, people had heard of return, they have heard of risk, but Harry Markowitz was the first to formalize it. Well, Harry Markowitz then was very careful to say, okay, standard deviation measures total risk. But there are components to standard deviation. There are two components to standard deviation, and they are systematic risk and unsystematic risk. I'm going to give you definitions here of those two. Now, we've talked a little bit about this in some other chapters, but here, I can give you the exact definition here today. You ready? Systematic risk is the variability in stock returns due to changes in economic factors. Things like inflation, things like oil prices, things like exchange rates. Wow. Unsystematic risk, on the other hand, is the variability in returns due to changes in firm-specific factors. So that's the relationship between total risk and the two pieces of relevant information that we've been talking about so far. What are pieces of relevant information for owning a share of stock? Information that relates to the general economy and information that relates to that specific company. Well, that's the difference between systematic and unsystematic risk. Now, what William Sharpe did, and he was thinking about this all during the Harry Markowitz years, is that, boy, if we diversify a portfolio, what we do is we virtually eliminate that unsystematic risk component, which leaves us with just systematic risk. And this is so important. We call systematic risk, some people call it market risk, some people call it economic risk. Remember that typology back in that first chapter? I think it was figure 1.3, maybe 1.4. Where we started with a risk over here on the left-hand side and we had a big tree over here. That top risk was market risk, and somewhere along those flow charts was systematic risk and unsystematic risk. So here's what William Sharpe did in 1964, among others. He said, look, if we invest in diversified portfolios, which we know everybody does, then total risk is not the appropriate measure of risk. Beta is our measure of systematic risk. What happens then when you wash away, when you virtually wash away unsystematic risk, what happens then is that this relationship back here, which on Harry Markowitz's Efficient Frontier is nonlinear, well, the relationship becomes linear. So notice we have linear function. We have it highlighted and bolded multiple times. And that's going to be super important as we get through this slide deck. What William Sharpe said in 1964 then was, hey, we're going to go ahead and call this model something different than what Harry Markowitz did in 1952. We're going to call this the capital asset pricing model, and there's the equation down at the bottom. Now we're going to review this as we go through this slide deck multiple times. So let's not worry about this too much in terms of memorizing it for now, but this is what William Sharpe said in 1964. He said, okay, let's build on everything that Harry Markowitz developed for us, but let's try to figure out what is the expected return on an individual stock. So look on the left-hand side of the equal sign, there's an R sub I. That's an individual stock I, like Johnson & Johnson or Apple. And William Sharpe said, hey, we're going to start with a risk-free rate of return. After all, what we expect to get out of Johnson & Johnson has to be at least as big as what we get out of the risk-free security, like a treasury bill from the U.S. federal government. So that's the starting point. But then notice there's a plus sign after that. So we're going to add to it. Oh my gosh, remember we had conversations on what I called the building blocks model. We had a whole bunch of plus signs, and that was mostly to help us come up with a yield to maturity on a bond. Well, we're doing kind of the same thing here, but it's now on a share of stock. We're starting with that risk-free rate of interest, just like we did with the building blocks model in a previous chapter. But what we're going to do is we're going to add stuff that goes on the floor of the New York Stock Exchange. We're not going to worry about all those plus signs in the building blocks model. What we're going to do is we're going to rely on beta. So William Sharpe said, hey, let's go to the floor of the New York Stock Exchange. Let's suppose that an investor owns a diversified portfolio, and let's define that diversified portfolio as owning one share of stock in every company that's traded on the floor of the New York Stock Exchange and the NASDAQ exchange and the German stock exchange and the Paris Bourse and all those stocks. William Sharpe called that the market portfolio. That makes perfect sense. If you own every share of stock out there, you own the market. And William Sharpe said, okay, the return on Johnson & Johnson is a function of the return on that market portfolio. That's what RM is right there. And then William Sharpe said, hey, what we need to do is make sure that we call that a premium. Let's subtract out that risk-free rate of interest, and we're going to call that a market risk premium, which sounds an awful lot like what we did for that building blocks model, the liquidity premium, the maturity premium, right? The default risk premium. Okay, so it's similar, not identical, but we call that in parentheses there, the market risk premium. And I'll show you an example here in just a little bit. What we do is we weight that. We weight that by the beta, by the measure of systematic risk. Are you ready for this? We weight that difference by the sensitivity of our stock, Johnson & Johnson, to changes in the market portfolio, to changes in economic risk, to those factors that will influence, like oil prices and wars and exchange rates and GDP and all those macroeconomic variables. So that's the beautiful capital asset pricing model there. This is Nobel Prize winning work. Makes perfect sense that GARP would be all over this and say, you know what, here's Harry Markowitz, Nobel Prize, here's William Sharpe, Nobel Prize. We ought to present this to our candidates on the exam. So let's try to figure out what kind of questions that GARP might ask. All right, there's the repeat of the capital asset pricing model equation. Notice up above the box, we have risk-free rate plus the beta times the equity risk premium. Now I called it back here the market risk premium, so make sure you can interchange those two terms. And we can draw a picture of this thing. What we can do is we can put expected return on the vertical axis. Okay, you ready for this? Let's go back to Harry Markowitz. There's the similarities. They both have expected return on the vertical axis. Harry Markowitz has the expected return on portfolios. William Sharpe has the expected return on individual stocks. Harry Markowitz has standard deviation on the horizontal axis. William Sharpe has beta on the horizontal axis. Now, what we need to do is we need to know a couple of things about beta. Beta, and you'll see this here in an equation in just a few minutes. Beta is defined as a covariance over a variance. Now hold off on that thought for just a second, but what that means is whenever you divide something by either the standard deviation or the variance, what you're doing is you are standardizing, okay? That's standard deviation and standardizing. And when you standardize something, you take a random variable, can you see my arms out here, that might have this range, and you put it in a vise and squeeze it down to a standard narrow range. Now, probably for the exam, that the range for betas will probably be between 0 and 2. Although when I wrote my dissertation, I calculated beta for probably 2,000 different stocks out there. I had some negative betas, and I had some betas that went up to like 3.2 or 3.3. But that's probably not too important. I think if you remember betas are generally between 0 and 2, that probably will be helpful for you. So stocks that have no risk have a 0 beta. Stocks that have average risk will have a beta of 1.0. Stocks that have high risk will have a beta close to 2. Now, here's the important thing. Now, this is by definition and construction, is that the beta of this market portfolio there, that RM there, the beta of the market portfolio is going to be 1.0. That's an important concept for you to memorize. And here, before we get into the actual statistics and the formula for the definition of beta, you'll see that later on. Think about it this way. If you go to the New York Stock Exchange, you have a bunch of low beta stocks, 0.2, 0.3, 0.4. You have a bunch of high beta stocks, 1.8, 1.5, 1.7, right? If you take the average of all of those, you get 1. So that's kind of, Jim's shortcut to memorizing that the beta of the market portfolio is 1. Now, what we can do is we can plot those 2 points down on the the vertical axis. There's the risk-free rate of interest. Notice it's not at the origin, so it's not 0, it's a positive number. And then we go out to portfolio M, which is the market portfolio, which has a beta of 1, and it has, over on the vertical axis, the expected return on the market portfolio. If you draw a line between those two, you get what is known as the security market line. Security market line is nothing more than a picture of the capital asset pricing model. Now, what's super important is that William Sharpe and Lintner and Mawson, those are 2 other guys who did this simultaneously and independently, that these guys, they'd said that every stock will fall directly on the security market line. In other words, those are fairly priced. So this builds on all of the work that Harry Markowitz did in 1952. But now, when we put beta on the horizontal axis, we introduce some new terms. Remember, we're putting beta there because we're assuming that all investors hold well-diversified portfolios. Now, if there is a portfolio that is up in the left quadrant, we called that unattainable in the Harry Markowitz world. But now what we're going to do is we're going to call that undervalued. If a stock is above the security market line, it's undervalued because, think about it, we want that stock. It has low risk, but it has high expected return. We want that stock. Everybody's going to want that stock. So everyone shows up on the New York Stock Exchange and they bid up the price of that stock, thus lowering its expected return until it falls directly on the security market line. So equilibrium conditions, supply and demand, marginal cost, marginal benefit that occur on the floor of the New York Stock Exchange will take any individual stock that is undervalued and force it back down to being fairly valued. On the other hand, suppose that you found a stock that was below the security market line. Think about what that means. It has too much risk for its expected return. Nobody wants that thing. So no one's going to show up on the floor of the New York Stock Exchange. The price will be bid down and its expected return will increase, thus forcing that share of stock to be located directly on the security market line. Remember this, security market line is the line of fairly priced securities according to Nobel Prize winning William Sharpe. Any stock that is above it is undervalued. Any stock that is below it is overvalued. So my gosh, sounds to me like there'll be one question on the exam for you to identify an undervalued, fairly valued, overvalued, or efficient, inefficient, or unattainable portfolios. Gosh, wouldn't it be awesome if you got 3 or 4 questions on that? Now, just like Harry Markowitz had assumptions. William Sharpe had some assumptions, and many of those assumptions are identical or at least similar. There you go. No transactions, no taxes. All assets are marketable or liquid. That means you can sell them pretty quickly. So there we go. Investors are price takers. All right. So there's the similarities with the Harry Markowitz. But William Sharpe also added a couple of ones. He said that all assets are infinitely divisible, meaning that you can buy fractions of shares of stock. William Sharpe also added a utility function that was based solely on the expected portfolio return, but also the individual returns on those individual shares of stock. And risk, now remember there, the and risk in the Harry Markowitz world, that risk was standard deviation. In the William Sharpe world, that risk is beta. And that last one there, this is relatively minor, but there's always a good exam question embedded in this. One of the first criticisms of William Sharpe's model was that it didn't include multiple periods. Suppose somebody wanted to invest for retirement. Well, you could go from today all the way out to retirement. That was one period, but clearly some of these assumptions would not hold over 20 years or 30 years. So single period, and that single period is the same for all investors. Now, of course, we can go ahead and take a look at the security market line with beta on the horizontal axis, but we can then compare it to the capital market line with standard deviation on the horizontal axis. So let's go back here to this thing here. Here's the efficient frontier. This is the world of risky equity securities. What William Sharpe did in 1964 was draw the security market line. Well, Harry Markowitz and his followers said, oh, we can draw a line too. And so what happened after William Sharpe was that lots of college professors, they said, all right, let's do something else here. What if we combine the Harry Markowitz equity world with a treasury security, with a risk-free asset? So there we go. We have a risk-free asset on the vertical axis. Notice it's positive there, right? It's not at the origin. And if we draw a line with the tangent point on that Harry Markowitz efficient frontier, we get something called the capital market line. Now, if you ever meet someone who has a PhD in finance like me, you can ask that individual, you can say, hey, when you guys were in your PhD program, did you have to prove that the tangent portfolio was in fact the market portfolio? And these individuals say, oh yeah, this was one of the first things that we do. So of course GARP isn't interested in you proving that the tangency portfolio is the market portfolio, but take my word for it, after lots and lots of math and several chalkboards. When I was in graduate school, we had to write on the chalkboards of derivations and substitutions and all sorts of fun calculus. So remember that tangent portfolio is the market portfolio, owning one share of stock of every stock that is out there. And if you draw a line between those points, you get what's known as the capital market line. So remember, capital market line is a line that lays on top of Harry Markowitz's efficient frontier, standard deviation down there on the horizontal axis. Now, one of the awesome things here, and this is a question I always ask my students here, not quite sure that GARP emphasizes this enough in this reading, but it's super important, is that when you add a treasury security to Harry Markowitz's equity universe, the relationship between risk and return becomes linear, just like it did in the security market line. That's why we can call it a line, because the relationship between risk and return is linear. So look at that learning objective up there. Interpret and compare the capital market line and the security market line. So hopefully you've been paying close attention to the last, 15 minutes or so. So you should be able to answer that question. Now, a couple of other things here about the capital market line in terms of its application to investments and individual and institutional investors. There's the capital market line. Notice that it's in red. Notice risk-free rate 10%, so it's above the origin. So this is what happens here. What investors do is that they make a decision that is out of their hands. In order to own an efficient portfolio in the equity universe, they're going to own the market portfolio. Every investor owns the market portfolio according to Harry Markowitz and the capital market line. But that doesn't mean that every investor ends up at that market portfolio point. Some investors want less risk. Some investors want more risk. So what investors do is they move upwards and to the right or downwards into the left. This is called the separation theorem. So what investors do is they buy the market portfolio, and then some investors who want less risk will buy treasuries. So what does it mean when you buy a treasury? You're lending money to the government. That's the lending portfolio. Lending is to the left of the market portfolio. If you want to go up and to the right, you use leverage. We call that the borrowing portfolio. So we can use margin accounts. We can use derivative securities. Gosh, we'll talk about that in many, many chapters in the future. So this is a great exam question. How do investors invest in the market portfolio and then alter their allocations to achieve their desired expected return? Well, this is what they do, right? Notice out on the top right, if that's the market portfolio out there, M, well, investors could own the market portfolio, and that's an efficient portfolio. Or they could have 75% in the market portfolio, which means they have 25% in the risk-free security. And they can go down to 65% and 50% and 40 and 30 and 12. Or note that 0% in the market portfolio means 100% invested in treasury securities. Also note that you can go out above the market portfolio by using margins and derivatives, etc., etc. But here's really the cool thing. You ready for this? So what did we say? I'm going to go all the way back here. What did we say that red curve is? That's the Harry Markowitz efficient frontier. But when you add a treasury security to the efficient set of points, the relationship becomes linear, and then the capital market line becomes our new efficient frontier. So there's the red capital market line. Think about it this way. That is our new efficient frontier. What's the link between the capital market line and Harry Markowitz? That link is the tangency portfolio, the market portfolio. Now, this is why that dude from Vanguard years and years ago, you guys know who I'm talking about, JB, right? John Bogle, he said, hey, I'm going to go ahead and put together a Vanguard 500 index mutual fund. People initially said to him, you got to be out of your mind. Nobody wants to have the market portfolio. We want to beat the market portfolio. We need active investment. And that's when John said, well, I read Harry Markowitz, and anybody who wants an efficient portfolio can invest in my Vanguard 500 index fund. And I'm guessing that you know that the Vanguard 500 index fund, it doesn't have $100 million worth of assets. Yes. Oh my gosh. Isn't that an awesome application of theory meeting real investment world stuff? All right. I did warn you a little bit ago that I'd show you the equation for the capital market line. What you need to know is that this thing is virtually identical. Gosh, I didn't just say that. Ready? How about virtually similar? Yeah, I went ahead and said that. But the capital market line and the capital asset pricing model, they start with the same stuff. Notice there's a risk-free rate of interest. Notice there's a plus sign. Notice in a numerator, there is the difference between the return on the market portfolio and the risk-free rate. But now, instead of multiplying that by beta, which is our measure of systematic risk, we're going to multiply it by the ratio of the standard deviation of the portfolio in question by the standard deviation of the market portfolio. So you should see that the market portfolio and the risk-free rate of interest plays huge roles, critical roles in both SML and CML. There's another equation for you to memorize. There's the capital asset pricing model, or the security market line down in the bottom. So there we go. And this is just a summary of what I have been saying. I don't know, do you need to take a picture of this one? I haven't had you take a picture of a slide. Sure, take a picture of this slide. Notice some of those bullet points. Oh, we have words like efficient and inefficient. We have words like undervalued and overvalued. Look at the bottom, graphical representation. It's a picture of the capital asset pricing model, systematic risk. And we know those things. So let's go ahead and do a couple of problems here, which sound an awful lot like. Let's go ahead and have this show up on the exam. So calculate the expected return on an asset. It's probably going to be a share of stock on the exam, but it could be almost any asset. So their risk-free rate 3%, market portfolio of 10. All right, remember now, this is super important. What GARP could do on the exam is they could give you the market portfolio of 10%, or they could give you the market risk premium or the equity risk premium. So 7%, right? 10 minus 3 is 7. Beta of this asset is 1.25. So let me tell you a little bit more about beta, although we'll do this here in just a second. Remember what I said, market portfolio has a beta of 1. Average beta in the stock market is 1. So here, our stock has a beta of 125. It has 25% more systematic risk. It has 25% more sensitivity to changes in macroeconomic variables. So therefore, if we have more systematic risk, more sensitivity, well, then we ought to expect more return than we get out of the market portfolio. Look, if we want a beta of 1, we're going to get 10%, right? Or we're going to expect to get 10%. But if we have a beta of 1.25, we ought to get more. So how do we get more? Well, we use the capital asset pricing model. So this is super simple. So we do, and by the way, make sure you don't violate the distributive property of mathematics on the exam. So I always tell my students to do the inside of the parentheses. So take 10 minus 3 equals 7, multiply that by 125, and then swing back and add the 3%, and that gets you 1175. Of course, 1175 is greater than 10. We expected that, but here's the Nobel Prize winning work that allows us to come up with a reasonable expectation for the return on this asset. Now, how about if we're asked to do something similar, but we're not given beta, we're given standard deviation. So here we have some extra information in the question stem. Risk-free 4.5, market portfolio 11.4, but the standard deviation of our portfolio is 14. The standard deviation of the market portfolio is 26. So in relation, our portfolio has less risk than the market portfolio. Therefore, we should expect less of a return. So we're going to use the capital market line, use our equation from before to come up with a reasonable expectation. So we're going to do the same thing there. We got 4.5% plus the difference between 11.4 and 4.5. But now, instead of multiplying it by beta like we did back here, we're just going to multiply by the ratio of our portfolio. Remember, always put the portfolio of interest in the numerator and the market portfolio in the denominator. And of course, if we take 26% standard deviation, well, then we expect 11.4%, right? But we're only taking 14%, almost half of the risk. No, more than half of the risk, and we're only going to get 8.22%. All right. Let's do one final quick question here where we're going to compute the expected return on a portfolio that, and here, let me make sure we go back here, make sure you understand this. Where was that slide? Here we go. So in this slide, notice out on the top right, we had 100% invested in the market portfolio. And on the bottom left, we had 100% invested in the treasury security. And we had all those differences in between. So this is what we're doing in this problem here. Let me make sure I find the right one. All right, you ready? So 40% weight invested in the risk-free asset and the remainder in the market portfolio. So that must mean 60% in the market portfolio, right? So we have a risk-free rate, market portfolio, and then we just threw a standard deviation in there. We could have thrown a beta in there. You don't need that stuff. You know, I'm really good as a professor in giving students extra information in the question stem. And students always say, well, Jim, why would you give us stuff if we don't need? And I'd say, oh, my goodness gracious. You're going to have a supervisor, and he or she's going to ask you to provide him or her with a solution to a problem. And you're going to have to figure out what's relevant and what's irrelevant. So, of course, GARP is going to give you some extra information in the problem. So here, all we need to do, notice up at the top, we call this weighted average. So we're just taking a weighted average of 6 and 12. We can't add 6 and 12 and get 18 and divide by 2 and get 9. You know that'll be one of the multiple choice answers. So we have to do a weighted average. And so I hope you understand this. That gray box there is really just application of this thing right here. All right, I did say to you earlier that we were going to go ahead and have a really good conversation on systematic and unsystematic risk. So notice what we're doing in this graph. We've got standard deviation on the vertical axis and the number of stocks or assets in a portfolio. Now, this is what you need to know, that the average standard deviation on the floor of the New York Stock Exchange and the NASDAQ exchange is about 50%. What that means is that there's tremendous risk associated with investing in just one randomly selected stock. That's why we own tons and tons of stocks. So we start at the origin there. That's really just, let's say, one stock. And you see with the dotted line, the big blue dotted line up there, just envision that's 50%. Wow. I mean, that's just way too much risk. That's why when you guys hit the lottery this week for $100 million, you're not going to, buy a house and a car and all that stuff. You're not going to spend $20 million investing in NVIDIA. Although, if you'd have done that 5 or 7 years ago, however long that company's been around, you'd be a trillionaire by now. But you're still not going to do it because it's too much risk. But notice what happens. That when we add stocks to the portfolio, that red line goes down. It goes down, it goes down, it goes down, it goes down, until it becomes parallel with that small blue dotted line. Now, the reason that we are able to eliminate some portion of that total risk is because of the correlation coefficients between and among all the stocks in the portfolio. So stock 2 and 3 and 4 and 10 and 12 and 100. Right? So what happens is that once we get to that parallel point out there, we're going to call that a well-diversified portfolio. Think of it as the market portfolio. When we hit the market portfolio, what we've done is we have, and this is what we say in the academic world, we have virtually eliminated unsystematic risk. Here on the slide, we call it specific risk, firm-specific risk, idiosyncratic risk. There are lots and lots of names out there for it. But what we have down at the bottom, we're left with just systematic risk. And here's the cool application question, is that investors will hold the market portfolio, right? Going back to Harry Markowitz. But what they will do is they will move downward or upward on that capital market line, which then means that each of those stocks has its own unique beta. And so what investors get to do is investors get to pick the height of that little dotted blue line. If investors like high beta stocks, well, then that'll be pretty high. If the investors like low beta stocks, well, then that'll be pretty low. The important point here is that diversification virtually eliminates unsystematic risk. but it does nothing to systematic risk. I told you earlier that I was going to give you a formula for beta. Well, now is that time. So look at the beta for company I. Remember what I said earlier? It's a covariance over variance. So are you ready for that? So that little sigma with IM as the subscript, that tells us that's the covariance between the market portfolio and the individual stock. The sigma squared sub m in the denominator, that's the variance of the market portfolio. So this is super important to remember. This will help you on the exam. Remember that beta is a covariance over a variance, and as such is a standardized random variable, which generally has the range of between 0 and 2. Now, what we can do is we can substitute in there, we can substitute this correlation coefficient. Correlation coefficient is nothing more than another standardized random variable. And if you substitute in there, what you get is the beta can be the correlation coefficient between the individual stock and the market portfolio. There's that rho, right? It looks like a funny looking P. And then we multiply that, much like we did in the capital market line, the standard deviation of the individual stock divided by the standard deviation of the market portfolio. So clearly, memorize the red, memorize the blue, so that you can compute the beta of an individual stock depending on what GARP gives you in the problem. Now, one of the examples inside of the chapter looks a little bit like this, so I thought we would do a problem here. Risk-free rate 5, standard deviation 40, correlation 0.8, market portfolio 20, return on the market portfolio is 10. All right, so the first thing that we're going to do is we're going to take some of that stuff that's given in the question stem, and we're going to go back here and use the blue equation. There's our correlation coefficient, 8. There's our 4 divided by 2. So there's our beta, 1.6. So what do we say here? This security has 60% more systematic risk than the market portfolio. Let's throw that into the capital asset pricing model. 5%, right? 10 minus 5. So there you go. Here's a great problem, and GARP loves to do this. They love to ask you 2 problems inside of 1 problem. So given the question stem, first thing you have to do is compute beta. Second thing you have to do is compute the expected return. All right, let's finish up with this last learning objective. Sharpe, Treynor, Jensen, information ratio, and the Sortino ratio. And so what these things really do is they say something like, all right, here we are. We're in the Harry Markowitz world. We're in the William Sharpe world. We know standard deviation is an important measure of total risk. We know beta is an important measure, is the critical measure, is the measure of systematic risk. Let's use those risk measures to try to evaluate the performance of individual portfolios or mutual funds. Those of you who go to the Morningstar software like I do in my finance trading lab with my students all the time, you'll know that it's super easy to compare different mutual funds. They're Sharpe and they're Treynor. I'm guessing you guys know these terms, but I'll go ahead and pretend that you've never heard of these things so that we make sure you get the basics done. All right, most of these performance measures are going to have a premium in their numerator. So look at Treynor there, return on our portfolio, maybe it's one mutual fund, minus the risk-free rate of interest. So always think of this numerator as some kind of a premium. Here it's just our regular old portfolio. You know, suppose I'm Jim's mutual fund, I have Jim's fund. So we want to say, hey, how does Jim's fund do? And we're going to use all of these measures to kind of track it, and then we can compare it against Jenny's mutual fund. Hey, maybe I'm a great mutual fund manager, but maybe Jenny outperforms me by each of these measures. That's why the learning objective says calculate and compare. So I'm guessing what GARP is going to do is give you a table and say, hey, which one is better with Treynor? Which one is better with Sortino? That's the standard kind of a question. So these equations are pretty simple to remember. Remember Treynor, you divide by beta. Here's just a quick analogy, and we'll do this with Treynor, but you can do this with all of these things. So two players, A and B. What we're doing is we're going to decide, is player A more efficient or performs better than player B? So look, player A has 30 points, but his teammates have 22. Player B has 25 while his teammates have 18. So you should be thinking about like marginality, marginal cost, marginal benefits. So look, player A outscored his team by 8. Player B outscored his team by 7. But we need to do some relative comparison. Which one is better? So all we're going to do is take a ratio, okay? So 30 over 22, 25 over 18. That gets us 1.36 and 1.39. So while it looked like, and clearly player A scored more points, but player B was, can we call it more efficient? But at least they perform better. So take this simple basketball analogy and apply it to all of these performance measures. All right, so remember, let me go back here real quick. So Treynor, we divide by we divide by beta. So we're assuming that the appropriate measure is beta. So when you use Treynor, when you know you have well-diversified portfolio. So look, more volatile, less volatile, relative performance. So look at the very bottom there in terms of relative volatility. Sharpe, on the other hand, divides by total risk because remember, William Sharpe came along right after Harry Markowitz and he was saying, oh, standard deviation is our measure of total risk. This was, of course, before William Sharpe did the capital asset pricing model. So don't think Sharpe divided by beta because of CAPM, Sharpe divided by standard deviation. This is why I love giving students history lessons, because it gives you some perspective of the evolution of how these things occurred. So note, Sharpe has the same thing in the numerator. There's some kind of a premium, but we're dividing by standard deviation. Of course, just like Treynor, we want the higher ratio or the highest. Now we want the Sharpe ratio. But notice, with Treynor, we're assuming well-diversified portfolios. With Sharpe, we're worried that the portfolio is not fully diversified. That's super important. Let's do a quick example here. We have an investor, $1 million in a portfolio, return of 10, volatility of 8. So here's the GARP and us calling standard deviation volatility. So make sure you can interchange those two terms. Efficient portfolio, 17 and 10. Risk-free rate is 5. What is the Sharpe ratio? So there we go. We've got to take the difference in the numerator, right? 10 minus 5 and 17 minus 5. But we're going to divide now. One we're going to divide by 8 for the investor. One we're going to divide by 10 for the efficient portfolio. And so we get 6.3 or 1.2. So the efficient portfolio has the higher Sharpe ratio, therefore it has outperformed the investor A. Now, Michael Jensen then came along well after the capital asset pricing model was developed, and he said, hey, let's go ahead and use the capital asset pricing model to come up with another performance measure. This is called Jensen's alpha. So there's the little A, the Greek A. We're going to call that the extra return. Some people call it the excess return. Some people call it an abnormal return. But Jensen's alpha is really just a difference between how much the portfolio returned over a given period. Notice we have the actual return with an arrow up for R sub P. That's the actual return on the portfolio minus the expected return on the portfolio. And Michael Jensen said, well, why don't we just use capital asset pricing model as our measure of expected return? So there's CAPM, there's risk-free, there's beta, there's the return in the market portfolio. So this is Jensen's contribution here. Now, he had some other contributions later on, but he came up with this concept of an alpha. And what do we want? Well, we want to have Jim's mutual fund outperform its expected return. So we like to find mutual funds that have positive alphas. So look at that first diamond point under the box. Positive alpha, superior risk-adjusted returns. The fund manager is good at something, maybe selecting stocks or maybe something else or maybe something else. But once again, we're using beta. So we're assuming well-diversified portfolios, much like we did with Treynor, but not like we did with the Sharpe ratio. Look down at that bottom diamond point. A lot of times we take this Jensen's alpha, and I do this with my students in the investments class. I give them an assignment, and they have to go out and find some good mutual funds for a particular client. And I tell them, I say, whatever you do, don't come back with a mutual fund that has a negative alpha. Here's just a quick graphical interpretation. There's the security market line. So what do we want? We want positive alphas. We don't want negative alphas. That's the sub A and the sub B. Yeah, so this is a way that investors can measure this active returns. Is it worth it to pay the mutual fund manager a premium to generate a positive alpha? Well, we got to do marginal cost, marginal benefit stuff. We'll talk about that kind of things, those kind of things in a different day. You guys have your phones out. Here's a great slide. Take a picture of this. But I have summarized all this before. So the usage is probably the good application question. What was that? Where do we have the learning objective. So calculate, compare, and interpret. So that's what this table will help you do. Where am I there? Ranking portfolios, et cetera, et cetera. So all that stuff on the usage, I'm pretty sure I've covered all that. Which one should we use? There we go, Sharpe, appropriate for the entire portfolio. Treynor and Jensen, this is probably an extra layer of importance if we're looking for possible addition to the portfolio. So this goes back to that very first thing when I was talking about marginal costs and marginal benefits. Yeah, a couple of last things here. Tracking error. What we need to do is ask ourselves the question, all right, we have our portfolio returns and we have a benchmark return. Maybe that benchmark is the market portfolio, but maybe it is some other benchmark. Notice there we have our P, so that's our regular old return in the portfolio, and we're going to subtract the return on a benchmark portfolio. Could be market portfolio, could be something else. But if we take the standard deviation of the difference between those terms, those two returns, we get something called the tracking error. So look at that definition in the first bullet point. Divergence between the price behavior of a portfolio and the price behavior of a benchmark. So remember, tracking error is nothing more than another kind of standard deviation. Low tracking error means that we're performing very close to the market portfolio or the benchmark. High tracking error means that we are either smashing the benchmark or being smashed by the benchmark. Smashing, that's Jim's term. Notice what GARP used, beating the benchmark, significantly underperformed. Think about this, the Vanguard 500 index fund or an ETF 500 index fund, they should have super low tracking errors. But Jim's mutual fund, in which I invest in just my particular stocks that I like, let's suppose that I invest in only stocks that are related to horse racing. Oh, my, what am I going to have? I mean, I don't even know what a benchmark would be out there. I guess there's probably a horse racing benchmark out there, but I'll have a high tracking error compared to the market portfolio. So here's a good quick picture here. So look at the, here's our tracking error. The time is on the horizontal axis, so it's up and it's down, And you want to turn your head sideways. Don't do it too quickly. I don't want to give you vertigo. So there's a normal distribution. So there's just -4. There's a +4. So let's do two last things here. Information ratio. So all the stuff that we've just done on a tracking error, we're going to take same numerator, right? Portfolio return minus the benchmark return. Could be once again the market portfolio, and we're going to divide by the tracking error. So it's still a standard deviation, but it's not the standard deviation like we calculated in Harry Markowitz. It's the standard deviation essentially of the numerator. So the information ratio is relatively important, and it adds value to what we learned from before, and that value is down at the bottom there. So this is a great exam question. Information ratio, right? What does it tell us? The ability of the fund manager to gather all that information and use it to generate some kind of an excess return. Now, we've spent some good time talking about value at risk and expected shortfall and the left tail of the distribution. We did that a couple of lessons ago. Well, of course, in the investment world, we might only be interested in those returns that are below some acceptable rate of return. So we're going to call that the Sortino ratio, which in the denominator, we still have a standard deviation, but we eliminate the stuff on the right-hand side and we focus on the stuff on the left-hand side. So that's the semi-standard deviation in the denominator. Now, of course, that Sortino ratio, look at the second bullet point, focuses on negative deviation. And so we're focused on the left-hand side, maybe the left, probably not all the way to the left tail, but the left-hand side. And this allows us to make an extra layer of performance evaluation between and among funds based on just, kind of like what's the worst thing that can happen. There we go. I want you to close down. We've had a good, what's this been, an hour or so? I want you to close this down, but I want you to go to the chapter. There are 18 questions, and I promise you're going to whiz through those things in less than 10 minutes. So this was a good lesson. This was a lot of fun for me. I love talking about Harry Markowitz and Efficient Frontiers. So as always, good luck studying, and have a great day.